Michael publishes something about every 2 weeks, and additionally, one of the things that our audience and our clients tell us is they love the fact that he's not afraid to speak his mind. It oftentimes scares us, but he's also not afraid to take non-consensus views. And so we've asked Michael today to share, much like Paul, what is going on in Vietnam, what are the opportunities, what are the threats. We're going to talk a bit about what's going on with the U.S. and real politics. And so I think hopefully this will answer some of the questions that Paul introduced that you have as well. So Michael, thank you for joining us.
Okay, thanks. I'm going to start my presentation today with a question for the audience. Japan, South Korea, and China have obviously been some of the most amazing economic miracles in modern history. I have 3 dates up here, and I'm going to ask, and those dates were obviously in the midst of when those countries were really taking off. And I'm going to ask just a quick shout out from the audience. Can anyone tell me, not my coworkers, because they know the answer already, can anyone tell me what event happened in those 3 countries in each of those 3 years? Big coming out economic event. Olympics. Yeah, I knew it was an easy question. Okay. What I want to talk about to kind of open the setting for today is that the Olympics is a big kind of you have arrived moment on the world economy stage, right? This is when you really, you're going along and suddenly the growth trajectory either goes at a faster pace or you become much more significant in the world economy. The prediction that I'm making for today is that Vietnam will host the Olympics in, I'm going to say in a decade plus. So it depends on the timing of the year and blah, 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 this kind of stuff. I put 10 to 20 years to be prudent, but the reality is I think we are now on track to host the Olympics. Why am I talking about this? The reason I'm talking about this is because we just had this comprehensive strategic partnership in the Biden visit. I'm viewing this as what I'm calling a pre-Olympic moment. And what do I mean by that? It's a big deal, of course. We'll talk more about the details of that. But why did I use this terminology here, a pre-Olympics moment? The reason I use that is because when we started thinking about how can we frame and how can we explain to people how much of a big deal this is, the U.S.-Vietnam Comprehensive Economic Partnership. When we start thinking about what's the clearest way that we can kind of explain that it's a much bigger deal than most people realize, the thing that popped into our mind is that if you look at those countries when they hosted the Olympics, actually, if you look about 10 years before they hosted the Olympics, there were some very clear defining events and things that happened in their countries. So, in Japan's case, you may know that in the early 1950s, the Korean War was going on, so that a lot of the production for that was done in Japan. Korea was, in the 10 years before it hosted the Olympics, its economy was kind of on a good, solid trajectory, and then some events happened within the country that kind of pushed it up on a faster trajectory. And in China's case, I believe that the way that they navigated the Asian financial crisis gave foreign investors a lot of confidence to put money into the country. Remember, that was around 97. The Olympics are in basically around 10 years later. So what the contention that we're making is that, and this is also as a framing device to how to think about this U.S.-Vietnam Comprehensive Strategic Partnership, is that this is going to be akin to these defining moments for these other countries. So we are now on the track. 10 plus years, 15 years, whatever it ends up being. The key thing is that we are now on the track to have a very momentous coming out event. The strategic partnership itself, that having been said, the strategic partnership itself in the short term is actually not really going to move the needle that much for the economy this year, next year, maybe even 2025. If you look carefully at the things that were announced, there was a bunch of MOUs, and the U.S. is going to donate a bit of money to help try to train some semiconductor engineers. Business Week magazine is going to publish in Vietnamese language. Okay, that's good. But you can see the things that are immediately happening are not really enough to move the GDP growth by 1 percentage point. That having been said, in the long run, over the next 10 years, it's, as I just alluded to, it's a much bigger deal than what most people realize. First and foremost, because the US is really right now not a big investor in Vietnam. Basically less than 3% of FDI. Korea and Japan are basically 1/2 plus of FDI into Vietnam. I've talked about that topic a lot in previous presentations and webinars. Long story short, you know, Korea and Japan, they have some demographics issues going on, et cetera, et cetera. But now that Vietnam has got the kind of really official stamp of approval of the U.S., and actually I would go further and say got the encouragement of the U.S. establishment, the U.S. elites, the U.S. government, you're going to see a lot more FDI come into the country now. Why is this happening right now? Why is the U.S. doing this? Okay, this is where we get to this topic of the realpolitik. So realpolitik is like when you see the world in very clear way, without ideology, you think about what are countries' interests and how are they maneuvering. The reason this is happening is because certainly the U.S.-China rivalry is a big part of the picture, and I'll come back to that in a second. But I want to make it an even bigger story. So what's the story is that the U.S. is responding to an increase in multipolarity in the world. So it's not just the U.S.-China. You know, now we have this BRICS, we have Saudi Arabia, we have possibility that oil might be increasingly priced not in U.S. dollars. So there's some very, very smart people that are working in the State Department that understand all of this that are happening in the U.S. policy establishment, and they see, or they're concerned about the U.S. influence in EM countries in particular. They're worried that it's the influence of the U.S. in EM is declining. And so therefore, they've come to Vietnam, and they've essentially said, we're going to give you huge financial inducements, basically to be our friend. So this is kind of the reality of what's happening. And lest you have any doubt in your mind about the significance of when the U.S. targets someone for an economic upgrade, Mark mentioned, and it's a very good point, that the whole East Asian development model has been very important for all those countries to, Japan, Korea, Taiwan, et cetera. And yes, all those factors are very important: high savings rate, high work ethic, emphasis on education. We don't detract from that. But let's get real. There was another very important thing that was also happening at the same time. It's not just that people in Asia work really hard. The other thing that was happening is that Washington, D.C. essentially wanted those countries to prosper. So the first ones, of course, this is part of the Cold War strategy. And then the whole China story is, as you know, a different story, that there was an idea that if we let China prosper, like they'll become more like us, kind of a thing. But for whatever reason, the important point here is that when the richest country, the biggest economy in the world says, we want you to upgrade, to prosper, it's going to happen. This is another little thing about, these people are taking this very seriously. Council on Foreign Relations, all the think tanks in Washington are talking about this topic of the U.S. influence around the world. The whole issue that whether they'll end up making their own currency or not, that's a whole nother, who knows. But the point is that the world is really fracturing into a multipolar world. That having been said, that's kind of the fear that the policymakers have in Washington. By the way, I know some of these people personally, and this is what is on their mind. But let's bring it back to what's actually been happening, which is the U.S.-China story. And that keeps, the tensions keep intensifying. We see, more and more developments on this. The point I want to make here, because I think almost every investor conference we've had for probably about the last 4 years, we've always had a newspaper headline slide about, wow, now this is happening, now this is happening. And the point that I want to make here is that the way to think about this is that first things pop up in the newspaper, and then they pop up in the actual real economic activity and real economic numbers. So we've been seeing these kind of headlines for a few years now, and now we're really seeing it in the numbers. This is the amount of stuff that U.S. imports every year, the proportion, and what you can see is China's share, essentially China's market share of selling stuff to the U.S. is back down to the lowest level since 2006. So you get the headlines, and then you get the economic reality. And by the way, who has benefited the most from this? Vietnam has benefited. So this is China losing market share in the stuff that it sells to the U.S., and this is Vietnam picking up market share. This is in Asia. Mexico has also done pretty well, but Mexico is probably the only other country in the world that's really picking up share. And that's mainly in the automobile industry, whereas for us, it's mainly in electronics and higher value-added products. So this is the reality of what's happening. And so, yeah, I mean, the biggest, most important theme that I wanted to get across today is that the U.S.-Vietnam comprehensive partnership, it's actually a much, much bigger deal than most people believe. And that's why we came up with this framing device that, this puts us on the track to host the Olympics. The other thing I want to talk about is let's bring it back down to, this is sort of the next 5 years, 10 years, but let me just talk about what's happening right now. And what's happening right now is that the U.S. is already our biggest export market. And so the exports to the U.S. and the exports to overall, these numbers have actually improved a little bit the last couple of days. But basically, our exports and our manufacturing are getting hit by the fact that the U.S., companies in the U.S. in 2022, they essentially over-ordered products from Asia. So remember, there was the COVID supply chain stuff that was going on, and so you had people, understandably, companies that couldn't get the products that they were trying to order from Asia, they kind of hit the order button multiple times, like when you're on the elevator, boom, 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 boom. So they kind of over-ordered. And then the other thing is that companies were expecting that when the COVID restrictions lifted, that there would be kind of a spending boom, that people would go out and splash out and buy products. Now, of course, there was a spending boom in the US, and to some extent in Europe as well, but it's more on services like going out to eat, traveling, things of that nature. So this is the main thing that we got hit by this year. And this is coming to an end. And the fact that this is coming to an end means that the economy will recover next year. I'll show some charts about that in a second. And the other thing that's really happening is that the sentiment of local consumers is quite poor. If you disaggregate what's happening from tourism, which is our biggest plus that's happening this year, if you pull apart the effect of tourism, which is boosting consumption, and probably you see that when you walk around outside, and you just look at what's happening among local consumers, local consumers, the consumption growth is very poor right now. That's partially, the sentiment has been impacted by partially just the first one, that the exports are down because, that's led to their layoffs in FDI factories, and that's kind of affected people's sentiment, understandably. And the other thing that's really dampened people's sentiment is the developments and the slowdown in the real estate market, which is something I'll also talk about in a second. So this is how things shape up for this year, and I am expecting a fairly difficult year for GDP growth. However, next year, it's very clear that we're going to have a big rebound in exports and manufacturing. And I'll show some charts about why I think that is in a second. So that will be the biggest thing that helps boost the economy. And the thing I'm kind of worried the most about is, it's clear that we're headed for kind of a global economic slowdown. I was actually expecting it for this year. In fact, any of you that attended this seminar last year, I was saying, well, I think the economy is going to slow down this year. It's been amazingly resilient, but I do think it's coming. You have to pay the piper at some point. And of course, with everything going on with El Nino and OPEC Plus, we're going to have, unfortunately, we'll have a resurgence of inflation. You've already started to see that a little bit. But be that as it may, the fact that our exports and manufacturing will be recovering will dominate those other factors. So I think we'll go back to our long-term growth of 6.5% next year. This is in pictures. I have two slides that show a little bit more precisely what's going on with this inventory story. So you see that last year, at around this time of the year, the inventories of U.S. Retailers and other consumer-facing firms was up over 20% year on year. And that's because of this, again, the over-ordering during the COVID supply chain problems and expectation there would be a big reopening boom. So 2023, this year, has been all about U.S. firms, and to some extent Europe as well, destocking. And that's the main reason why the exports and the manufacturing have been poor this year. However, this is now coming to an end. This process has now almost wound down. On the next slide here, I will show you that until recently, firms in the US were depleting inventories at the fastest pace in almost 10 years. But what we see now when we look at, for example, the PMI, and this is not just in Vietnam, when you look in China and you look at some other countries around Asia, is that the export orders are now recovering. Okay, it's going to recover at different pace for different products. If you look at, for example, garments and footwear, the inventories are still pretty high. But if you look at things like furniture, I'm talking about inventories in the US, but if you look at things like furniture, sporting goods, consumer electronics, the inventories have already been pretty much already gone. So you see now that some aggressive reordering of consumer electronics products from factories in Vietnam and factories in Asia in general. So that's kind of the story about why we expect a good rebound in economic growth next year. The story about the real estate market is something we could make a whole seminar just on this topic only. The main points that I want to make here is that the situation in Vietnam is very, very different than in China. In China, massive overbuilding, massive vacancy rate, whereas in Vietnam, we're basically not building enough housing units for the emerging middle class people that need housing. I'm not talking about the high-end crazy stuff. I'm talking about $1,500 per square meter for housing for normal people. We're not making nearly enough housing units. The main bottleneck is related to some zoning and approvals issues that has to do with dynamics with the government and inside the government, getting approvals, things of this nature. Also, to some extent, there are some financing issues there as well, although that was more of an issue in the beginning of this year, and it's becoming less of an issue now. But the main point here is that it's completely different than China. There's not a huge overhang of empty houses here. The next topic I want to talk about briefly is what's going on and how to think about the foreign exchange rate and also interest rates in Vietnam, because interest rates were particularly important for what's going on in the stock market, which my colleagues will talk about later in the day. The way I will think about it, and I think this is the right way to think about it, is that Vietnam policymakers are targeting a stable USD VND exchange rate because they want to encourage foreign investment. Because they saw that China did that after the Asian financial crisis, and after China was able to maintain a very stable exchange rate, it encouraged a lot of foreign flows into the country because foreigners feel comfortable. They don't worry like, if I put my money in Vietnam, am I going to lose like in Indonesia during the Asian financial crisis, lose a third in how many weeks? So I believe they're doing this because the foreign investment, FDI, is a very, very, very important, arguably the most important growth driver for the country. That's not an official policy, but it's kind of obvious that's what they're doing. This is also not an official policy. It's not written down anywhere. We're not privy to any kind of inside information. But if you look at the actions of the State Bank of Vietnam, it's pretty clear that they don't want more than sort of 2 or 3% depreciation in a year. So if you really watch, very, very geeky level, watch what's going on in the money market and the T-bill issuance and this and that, you can see that when the currency starts to depreciate by about 2 or 3% in a year, that's when you'll see the central bank come in and kind of take some actions to stem, that they don't want more. They want to keep it really stable. And by the way, this is from Global Finance magazine. They get a lot of accolades for how they're managing because the role of a central bank is really to protect the currency and to respond to inflation. And so they're getting an A+ rating this year, and that's after everything that happened last year. What happened last year? Well, you may recall that in late 2022, the value of the dollar, the DXY index, surged by almost 20% because of things that were going on in the world at that time. And so what Vietnam did is they hiked interest rates aggressively at the end of last year. And again, they did it in order to protect the currency. Inflation was really just 3% last year. So that's not a level in which you really start aggressively hiking rates. So they did it to protect the currency. And then in this year, in the beginning of the year, so we had a big slowdown in GDP growth because of this phenomenon about the manufacturing, the exports. And the State Bank of Vietnam cut rates fairly aggressively in response to the slowdown in growth. But the key point here is the reason they were able to cut rates aggressively is because the FX rate was stable. I think if the rate was not stable, you wouldn't have seen them being as aggressive in cutting rates in the beginning of this year. The rate was basically flat, and that's despite the fact that the Fed was hiking rates. And so they said, okay, growth is slow, we're okay on the currency, let's go in and cut rates. And as a side point, I will mention that one of the reasons why the exchange rate was been relatively stable, I mean, despite the fact that they were cutting rates at the time that the Fed was hiking rates, et cetera, is because we had a big surge in the trade surplus. And I will right now take a moment of credit for myself because I think I was the only one that was kind of predicting we were going to have a huge increase in the trade surplus this year. And that is the main reason that they were able to keep in the beginning of the year, that they didn't, they were able to cut rates. However, what's happened in more recent weeks is that it's just becoming the difference in interest rates between as the U.S. just keeps hiking relentlessly, the difference in the interest rates in Vietnam and in the U.S. is just too big. So right now, U.S. dollar interest rates are about 5 percentage points higher than dong interest rates, which is kind of incredible when you think about it, because normally you think of like depositing your money in an emerging market to get like high, attractive interest rate. But right now it's flipped the other way around. And because of that, and because of some other things, the currency's actually depreciated now by about 3%. And as I mentioned, as soon as we got down to about a 3% depreciation, that's when the state bank came in and said, okay, we can't let this go any further. And they started taking some actions. And the last thing I want to mention on this slide is you see that, so this is from the the middle of last year. So they, as I mentioned, they started hiking when the dollar started going up. So they hike rates, and the policy rate hikes and some other things also led to higher rates that you could actually get in the bank, higher bank deposit rates. And then everything started coming off as they started cutting policy rates. One of the reasons I put this slide here is because this actually, in my mind, and my colleagues Tu and Lynn, our head of research, are going to talk more about detail about the stock market. But in my mind, this chart kind of explains what the stock market this year. Because what was happening last year is when you had this surge in deposit rates, basically people were selling their stocks and putting the money in the bank because you could get like a really fabulous interest rate. And it was very popular to deposit your money for 6 months. And then what happened is as those 6-month deposits were coming due and rates were coming down, then the rates were not as attractive. And so then you saw people say, okay, well, let me just put my money back in the stock market. In my mind, this has been one of the main drivers of the stock market this year, which is why I mentioned this. Okay. I want to close, and I think, thank you, because you covered most of the points on my slides here, so thanks for that, by just some reminders of things that we often talk about in these presentations. The main thing, again, that I want to mention this year is that the U.S., and I said it so many times already, the U.S.-Vietnam Comprehensive Strategic Partnership, much bigger deal than most people realize, putting us on track to host the Olympics. But these other factors have not gone away. India and Vietnam are two of the only countries in the world where demographics are a plus, not a minus. Urbanization is still there. This last one, moving up the value chain, this was kind of the main theme of my presentation last year. And so I just have a slide here to remind or recap that this is how important this is. Some research from Harvard that basically when a country starts producing more complicated things, this is like the most important growth driver that there is for the country. So just a reminder of that, a reminder of the demographic story. We basically have about another 10 years to go of demographics being a major push for plus for the economy. And one last topic I want to cover before I wrap up is we do hear now increasingly, and by the way, particularly from local Vietnamese business people and investors, concerns that, okay, I'm worried that the FDI flow to Vietnam could get derailed in the future because of India, like they could effectively steal some of our share of FDI away, and also because of this global minimum tax issue. In the case of India, if you really look into it carefully, most FDI that's going into India right now is to produce products to be sold in the local market. For example, India is still a major importer of iPhones. They don't make enough iPhones to sell to their own population. So currently, that's the story for India. It's still very difficult from an ease of doing business point of view. Now, we've seen in the newspapers that Tim Cook and others are trying to put some pressure on the government to make it easier to hire and fire workers, this kind of stuff. But so far, as of right now, most of the FDI that's going in India is to sell to the domestic market. So I don't really regard India as a major competitor for Vietnam, and they are certainly not doing the East Asian development model. And the last thing that I do see people getting more concerned about is we're about to have this new system, the global minimum tax, which is basically not going to be easy to offer tax incentives to companies to come to your country. One of the reasons that we hear more and more about this is because the multinationals themselves are kind of griping about that, which is understandable. If you're a multinational, you don't want to be lose your tax benefits or whatever. But the reality is, and again, let's for a moment just get real. A company is not going to come to Vietnam versus going to China or Thailand or someplace else because of the tax rate is a little bit different for the first, 5 years, 10 years, whatever. That's in general, and there is research to back this up, that's not really going to be a factor that's going to move the needle when a company is thinking about which emerging market to invest in. The story with developed markets is completely different. With the developed market, yeah, tax can be a big incentive. And of course, the country I'm thinking of right now is Ireland. If you look at the workforce in Ireland, the quality of the workers, the wages, et cetera, is probably not that much different than the US or Netherlands or wherever. But Ireland, by kind of playing games with the taxes, was able to attract enormous FDI inflows. So when you're in the homogenous DM countries, yeah, that's more of an issue. But for Vietnam, the idea that the global minimum tax is going to somehow stop our FDI flows doesn't make any sense to me. And the last thing, is we do hear more and more about this idea that, okay, tax rates will go up for everybody, but then basically governments, not just Vietnam's government, but governments are going to basically find ways to kind of rebate some of the money back to the companies, in the form of, we'll pay for your worker housing or we'll pay for your whatever. So I'm not so worried about that issue. Okay, in summary, I said it so many times, this is a much bigger deal. The Biden visit's a much bigger deal than most people realize. Growth slowed this year because of the U.S. Inventory depletion cycle, going to pick up next year. We already see that in the PMI numbers. Export orders are recovering. And last point is GMT is not really a major risk or concern for Vietnam. Okay, that's a lot of information. Let me open it there for questions. Yeah.
I'm trying to talk about the public debt issue in Vietnam.
Yeah.
You introduced that the U.S. government is trying to provide a kind of financial inducement more to Vietnam. But how do you see the future impact to Vietnamese debt?
Okay.
Public debt issue in Vietnam, because they have been trying to limit that debt ceiling very strictly so far.
To be honest, I don't really see those two issues as being connected. So to be clear, basically what the U.S. is, if you look at how the U.S. Won the Cold War with Russia, one of the ways they did that is they went to Japan and they went to South Korea and they said, you can sell us as much stuff as you want and we'll never give you a hard time. It's pollution, trade unions, whatever, we're not interested, right? And so that's essentially what's happening in Vietnam. The issue about public debt is more related to something that came up in the previous presentation, which is infrastructure development. So in my mind, they've been overly tight with the public debt. Okay, it's good. I think the total goes around, it's probably around in the 40s or something now. So it's the fact that I don't know the number right off the top of my head means it's a non-issue. If it was something important, I'd be like, it's this, you know. So in my mind, though, if you look at like during COVID, one of the reasons we did not have inflation here is because every other country, including in this area, you had Indonesia doing quantitative easing for the first time ever. The government was actually printing money and giving it out to people to spend. Vietnam was pretty tight in the COVID fiscal response, and the reason they could do that is because the economy is sort of fundamentally strong. So for me, I would say that they're, if anything, probably overly prudent on the public finances. Yeah. Is there a mic? Okay.
Thank you very much, Michael. Yes, definitely the comprehensive partnership is a big deal for Vietnam and for the USA, but it's also can be and probably is a big deal for China. Now, we've seen China punishing Vietnam in a little way, but China can also exert a lot more influence on Vietnam and make Vietnam's life difficult or miserable. Can you talk a bit about that and how you see Vietnam handling that?
Yeah, okay. So, as you know, China has ginormous problems because basically what China did is, and Eric hates when I talk about this guy, Gershengorn, they did what's called the Gershengorn growth model. Gershengorn was a Harvard economics professor from, I think, Ukraine in the 1950s. And basically what he advocated is if you're a country that wants to catch up quickly, you do massive focus on investment. You know, so in the Soviet Union, they built all this industrial production that was kind of useless. And then in China, they built all these empty cities that were, you know, are empty. So they are now in the middle of, at the beginning of the hangover of that. And so that's going to be a 10-year process that is going to completely preoccupy them. I think if there are any geopolitical related things involving China, the reason China would do something geopolitical is not because they care what Vietnam, which by the way is less than 0.5% of global GDP, not because they care what's happening with Vietnam, you know, in the U.S., but because they would want it as an internal distraction for, you know, their own troubles. And this is why they have the social credit system, and they're kind of, you know, cracking down on people protesting when the value of their property went down, all this kind of stuff. And to me, if I was them, Vietnam would not be the place that I would want to, you know, start trouble to distract people, because it's, number one, is not a big enough of a distraction. Okay, thank you.